you, Miriam. Thank you very much for inviting me to give this seminar. And to all of you guys listening, I'm sorry I can't have a cup of coffee or hear about your latest research. If you see me at the AFA meeting or a later conference, please come up and introduce yourself and I can get a chance to meet you all. All right, so Miriam mentioned the papers that I'd like to talk about. Basically, this is to talk about the link between the Federal Reserve and the stock market. So the starting point is that monetary policies generally around the world set by a committee. That's because it's thought that groups reach better decisions than individuals. And also because if you think about the US or the ECB context, you want to have different geographical areas represented or possibly different economic constituencies. The median number of board members is around 8. The US has more. We have about 19. We have 19 members of the FOMC. The ECB has 25. And in both the US and the European context, there's some rotation, so not all the members vote at any given time. So what this talk is about is the tension between decision-making by a committee and effective communication. So as you're probably well aware, there's lots and lots of speeches by especially the Federal Reserve Bank presidents. And John Faust has argued that this is a tug of war over public sector expectations. Now, what I'm going to try to convince you over the next 45 minutes is that this cacophony of voices is actually even worse than you might have thought, in the sense that I'm going to try to convince you that there's not only a public cacophony, but also what I'm going to call a quiet cacophony, where Fed policymakers try to drive market expectations through informal communication with people in the market and in the media. So the talk is going to have 3 parts to it. The first part will be to review recent work in asset pricing that shows that there's large stock price movement at times where supposedly there's not much going on inside the Fed. I listed the 3 papers, the main papers in the literature. The last one is the new one that was on the cover page at the top. Then I'm going to take you through a history of leak discussions in the FOMC's own documents going back to the 40s. I'm going to do this to try to convince you that it's not just me who thinks there's lots of informal communication or leaks from the Fed, but that the Fed itself recognizes this, and we'll talk about some of the initiatives that they have taken to try to get around this. So the other element of the history will be to learn something about what's the economics of all of this. In the end, I'm going to try to convince you that the informal communication or leaks are generally due to infighting between different policymakers who disagree about whether one should go in a hawkish or dovish direction. And that the role of these leaks or informal communication is that essentially if you succeed in moving market expectations for what the Fed will do, that gives you the upper hand in the negotiations with your colleagues at the FOMC meeting. So we'll go through why do market expectations seem to matter for policy as we go through some of the quotes. We'll also learn something about what the costs of leaks are, and I listed the 3 main ones there. The third part will then be a very simple prisoner's dilemma type game theory model to understand the equilibrium outcome, who's going to leak or who's going to use informal communication. Is it going to be the hawks, the doves, or both? In the end, I'm going to argue that there's going to be a unique Nash equilibrium in which both parties, both the hawks and the doves, are going to leak in equilibrium. So the main ingredients of the model will simply be that policymakers disagree about optimal policy, and that market expectations, if you disclose something to the market, that to some extent ties your hands and reduces policy flexibility. And then finally, that you don't have to disclose all the news. There's some spin possible in the sense that the doves will want to disclose the dovish internally known information, and conversely for the hawks. And then as time permits, we'll hopefully have a discussion about what can be done to improve the situation. So I'm going to mostly talk about the Federal Reserve, but you may have seen the recent Reuters article about the ECB situation where President Lagarde has come in and tried to change supposedly their own leak regime. And the Reuters article is titled "No Phones, No Leaks." She also has some other initiatives that I'll go through right at the end of the talk and compare them to my suggestions for how to try to clamp down on some of this leaking at both the Fed and the ECB. All right, so let's talk through some of this asset pricing evidence. The literature really got started with the very nice paper by Luca and Munk in the JF on the pre-FOMC drift. So the graph shows the S&P 500 over time relative to the FOMC announcement. The solid line, that's for FOMC announcement days, and the flat line is for non-announcement days. And as you can see, there's basically a 50 basis points increase on average going up to FOMC statements, and that's pretty strange because that's part of the blackout period. There's not supposed to be any news coming out, and Luca and Munk's paper came out essentially as a puzzle paper. They argue that leaks are unrealistic from an institutional viewpoint, and that monetary policy news would have to have been systematically positive during the period, which is 94 to 2011. So then I discussed Luca and Munk's paper at the NBR asset pricing meeting back in, I think, 2012, and was very puzzled by it, and ended up writing this paper with Annette Vissing-Jorgensen and Adair Morse, extending the finding to study not only the FOMC announcement days, but all days, essentially. So we do effectively an event study of how the stock market does relative to FOMC meetings, but not just the meeting itself, but the whole cycle in between meetings. So at the Fed, they have 8 scheduled meetings per year. And so the paper is based on data from 94 to 2016. That's 184 FOMC cycles. And what's graphed here is the 5-day stock returns going forward from the point shown on the x-axis. So the first peak is the one over here. That's the one we know from Luca and Munk. The market does well around the FOMC announcement. But then notice how it also does well about 2 weeks later, 4 weeks later, and 6 weeks later. So our paper is about this whole FOMC cycle, and we actually argue that this is due to news from the Fed, and that news has in fact been on average positive over the period studied. And so I bullet pointed out here the arguments that be given in that paper. You can look up the associated evidence in the paper. So first, it's actually very informative to look at the data even before 1994 for when the target was changed. So in recent decades, they generally don't change the target in between the scheduled FOMC meetings. But prior to 1994, about 2/3 of the target changes were in between meetings. And so that gives kind of a real preference view into when the Fed does its thinking and its decision making. And we show that there's more intermeeting changes in these even weeks, weeks 0, 2, 4, and 6, in FOMC cycle time than in odd weeks. We also show that Fed fund futures rates on average declined in even weeks, consistent with policy news being unexpectedly accommodating over this period. Then we tried pretty hard to figure out what's going on inside the Fed. And there's very few things that one can follow from the outside. The one thing that you can get some minutes from on the board page is the board meetings of the board of governors. So those are the guys in Washington, the chair, the vice chair, and the other governors, and they have these internal meetings, which you generally don't hear much about in the press, but you can see a record that there has been a meeting on the Fed webpage. And we show that the even weeks are particularly high if they're on an even weekday that follow a board meeting on the board of governors. So that sort of suggests that when something exciting is going on inside the Fed, when policymakers get together, then news seems to reach market through informal channels. Now, getting to what exactly is going on with the even weeks in economic terms, we conjecture, but that's still a conjecture, that what matters is all the policymakers. And so under the Federal Reserve Act of 1935, I think is the latest update, the 12 reserve banks around the country have to send in their views on policy at least every 2 weeks. And so they don't all do it on the same schedule, but everyone will have sent in an updated view just before the FOMC meeting. And so you can see how if you were the board in Washington that had to sit around and figure out when is a good time to discuss how everyone's views are updating, doing it every 2 weeks would make sense, because then you would have a full fresh set of policy recommendation from the reserve banks. We also show that there's what we call a Fed put pattern in these even week returns, and that they tend to be particularly high following stock market declines. And so that's consistent with a commonly mentioned narrative of how the Fed has worked during this time, that basically when the market goes down, they view that as a signal about bad, negative growth news for the economy and react accordingly. And of course, we try to control for other things that could be going on, in particular macro news and speeches. All right, so let me turn then to the new paper on the governor's calendar. So in order to figure out a bit more of what's going on inside the Fed we submitted a whole bunch of freedom of information requests to the Board of Governors. The reason for putting in requests for the Board of Governors is that the reserve banks around the country, those are private banks, so they're not subject to FOIA law, but the board is a part of the government, and so you can submit requests for information about what's going on inside the Fed. So we put in requests for the calendars of all the governors going back to 1994, and we got them back to 2007, not for everybody. So you can see the list. Basically, we got the chairs and a few of the governors, but it adds up to a lot of calendar items, about 29,000 items. So then what we do with these calendars is to try to sort out, what's happening inside the Fed when you see high returns in even weeks. That's useful both for understanding the communication game between the policymakers potentially, but also from an asset pricing perspective. So remember how there's been, I think there was a couple of asset pricing meetings ago, there's now a literature on whether this FOMC cycle and the Lucas-Mönch effect is due to risk premia, or whether it is in fact due to monetary policy news having been on average accommodating over this period. And so one thing which is nice about studying these calendars in that context is that if you see high returns on even weekdays with events that no one knew were happening, then probably this whole cycle is not due to a risk premium, because investors need to know when events are happening in order to require a risk premium for taking on news. Whereas if on the other hand you see high returns, when some internal events are going on that the public doesn't know about, then you'd lean more towards this news being on average positive over this particular period. So our conjecture going into this is that the interactions between the governors in Washington and the 12 reserve bank presidents around the country, we suspect that they will be important, we'll see. Because we know from the Lucas-Mönch study that when the decision makers all get together, the governors and the presidents, right, that's precisely when the Lucas-Mönch returns show up. The FOMC meetings are either 1 or 2 day long, and so the pre-FOMC period is precisely the period where people are getting together. So let's take a look at the data. So here's an example of Ben Bernanke's calendar. This is just a randomly picked day in April 2011. Some days busier than others, but generally, 2 to 6 typically appointments per day. There's lots of meetings with staff. You see that as you read along. Then you can see on the Friday, the 22nd, some discussions with Sheila Bair from the FDIC. Then there's a call from one of the Reserve Bank presidents. So that's these regional Fed presidents. The following Monday, they have the pre-FOMC board meeting. That's one of these Board of Governors board meetings that I mentioned before. Then on Tuesday, a call from the CEO of Ford, another interaction with the Reserve Bank president, and then the FOMC meeting starts. So we have, thousands of pages of these calendars, and here's an overview of what information is available. So as I said, we got information back to 2007, and we have in red, those are the chairs, Bernanke, Powell, and Yellen. And then we have, for other governors, we have Brainerd, Fisher, and Tarul. I should say that it's a little unclear why some governors have agreed to give calendars and some have not. Jeremy Stein actually was very happy to give his calendar, but the Fed said that they could not share it because he hadn't approved that before he left. So just so Jeremy doesn't look bad in this, I wanted to mention that. All right, so what we're gonna do with these calendars is three things. First, we're just gonna tell you, what are the Fed guys doing? This is hopefully sort of an independent interest, but also we wanna then study first, what do the governors view as important in terms of their interactions, and then what happens on these even weekdays when we see high returns. Okay, so here is the results of just months and months and months of coding. We're actually not quite done cleaning up the last 1,000 items, but I suspect things will not change that much. So we have about 700 FOMC, so for local market committee interactions. That's more than the number of FOMC meetings during this period, but as you saw in Bernanke's calendar, one FOMC meeting will generate more than one entry, because first they'll have lunch. You see that Tuesday at 10:30, the meeting start, they have lunch, and then they have the meeting, and then there's a reception and blah, blah, blah. So you get more than one entry for one meeting. Then we have about 1,500 interactions between a governor and typically just one Federal Reserve Bank president. And then as you go down, there's lots of interactions of the board of governors amongst themselves, and there's tons of interactions with board staff. Then going to some external relations, there's lots of interactions with the media. Then there's tons of interactions with the US Congress and other parts of the administration. At the bottom, there's quite a lot of interaction with financial institutions, over 1,000. Lots of interaction with foreign central banks and various organizations. There's even some supposedly secret meetings going on. So that was a bit frustrating after all this FOIA coding. Now there's all these blacked out items in the calendars, but nonetheless, we'll have plenty of stuff to study. So let's start figuring out what's going on what day. So here's, let's do daily data first, and let's have the day follow the stock market hours. So we'll do 4 p.m. to 4 p.m. days. Then we're going to define 47 dummies based on all these different categories that we just talked through. So for example, the FOMC dummy will be 1 if there's one or more calendar items in the calendar that's a FOMC interaction. The vast majority of those are on day 0 or -1 in the FOMC cycle. Similarly, we'll define a dummy for a Federal Reserve Bank president item. As we saw, there's about 1,500 of those items. Those are fortunately spread out quite a bit over the FOMC cycle. So there's very few that are on day 0 and -1. That's going to be good for identification later on. Similarly for the other 45 categories. All right, so let's first try to be objective and not impose our views about what's important, policymaker interactions, even weeks, odd weeks. Let's just think about, what do the governors put on their calendar when they're busy? And so we're going to define busy as times where VIX is high. Presumably, those are times where they have a lot to think about in terms of deciding on policy and assessing the outlook. So we're going to run regressions, probit models along the lines listed at the bottom, where we have a dummy for one of these calendar item categories on the left. And on the right-hand side, we're just going to have VIX as of the day before, and include year dummies to account for different number of calendars per year. Notice that this approach will generate a significant beta on that VIX, the lag VIX, if calendar scheduling is somewhat flexible, so that unimportant stuff can be canceled if it's a stressful day, and important stuff can be scheduled. Stuff like the Jackson Hole conference is going to happen, whether they're busy or not. And so this approach will be less useful for picking up those inflexibly long pre-scheduled items. Okay, so that's it. Here's the result. So a bit unfortunate for figuring out what's happening. The redacted items come out with the highest t-stat. Okay, so one row here is one regression. But then, interestingly, the second highest t-stat is for predicting these governor-president interactions with flag wigs. The FOMC also comes in, not with a huge t-stat, because I think most of the FOMC meetings are scheduled long in advance, but there still is some FOMC conference calls and so forth. In terms of what's not important, so what do you not see when VIX is high? You see very few days where the calendar just says no appointments. And also, I didn't want to put this in writing, but it turns out actually the second least important category is interactions with academics, which is from our perspective a bit sad. All right, so that tells you what the governors themselves seem to think is important. And you saw the policymaker interaction show up both in terms of the president, interaction with the president, and interaction with the FOMC. Okay, so then let's move on to the asset pricing part. So let's just run daily regressions of the excess return on the stock market on a dummy for whether it's an even week. So those are the ones we ran in the FOMC cycle paper. But now let's try to include some interaction terms. In particular, let's include interactions of it's an even week and there's a calendar item of a given type happening on that day. Just to check, we're also going to include the interaction for the odd week. So the omitted category is odd weeks with none of this type of calendar item. Again, we're going to run first one regression per calendar item category. And I'm going to show you here just the ones where the interaction terms came out significant. And it's very much in line with what we saw from the VIX analysis. So the first column just shows, to confirm the FOMC cycle paper, that returns are higher in even weeks. You may remember from the graph that the 5-day return was about 50 basis points higher in even weeks. So that's about 10 basis points per day. And so that's this coefficient here. Okay, so what's new here is that the even week returns are even higher if it's a day with an FOMC item on the governor's calendars, or if the governors are talking to the presidents, or if there's a Fed conference. Notice down here that there's nothing going on with these odd week interactions. So it's something about the even weeks generating more informative, more useful information, and then that information reaching the market. Now, in column 5, let's put in all these interactions at the same time. And let's also put in one so that we have captured all even weekdays. Then we can actually do a decomposition of what's driving the high even week returns. And that is relatively straightforward. So there's about 1,500 even weekdays in the period from 2007 to 18, times we had 11 basis points. That's a total effect of that much, 164. You can count out that of that, more than 50 percentage points happens on even weekdays with these Federal Reserve Bank president-governor interactions. And then about 39 are due to the FOMC interactions, 22 is the conferences, and leaving not much actually. And so now we have sort of narrowed down that even weekdays with policymaker interactions are really the most important ones. I should also say that if you run this regression focusing only on days that follow Board of Governors board meetings, as we discussed before, then you see that the governor-president interactions are particularly important. So basically, when all the decision makers are interacting, then you really see high even week returns. And we haven't put this in the paper yet also, but these results are robust to controlling for governor or president speeches, and thus consistent with information reaching the market through informal channels. All right, so just for arguing causality, we also study hourly data where it's important to show that returns are earned after the start of these meetings. Now, we don't have all the calendars. Remember, we only got a handful of the governors. So it's okay if returns are also positive before, but it would be bad if the event study line is completely flat after the start of the meetings. So let me just show you this in an event study picture. So this is hours from the start of a calendar item that's either an FOMC or a governor-president interaction. And you can see that it slopes up after the interaction starts. So after one of these policymaker interactions starts, there's a little slope over here. This could be due to interactions in calendars that we don't have, but the key thing here is that the line slopes up after the meeting starts. So let me zoom in here on days 0 and 1 only and basically give a reinterpretation of Luca and Merck. So they talk about the pre-FOMC drift, and they draw their vertical line at the time of the FOMC announcement. Instead here, we're drawing our line when the policymakers start to interact. And then you get a normal looking event study picture, and things are not puzzling in the sense that an event happened and that information comes out to the market. So from the calendar analysis, I conclude two things. First, of all the different interactions that could have mattered, it seems to be the interactions between policymakers themselves that generate information that reach the market, both the FOMC interactions and these governor-president interactions. And then second, from an asset pricing perspective, of course, this ties the FOMC cycle more causally to the Fed, since we now can pin down even better what's going on inside the Fed in these even weeks. But also it suggests that this FOMC cycle in stock returns is probably not a risk premium, because no one knows when these governor-president interactions are taking place. No one outside the Fed itself. So hopefully by now you're beginning to think that there's something fishy going on with information from the Fed reaching the markets in informal ways. Just so you don't think I'm just making this up, let me just show you some evidence that the Fed itself is pretty worried about this, and then we'll write up a little model of how these guys are interacting. So I went to the board's webpage and I searched for the words listed at the top, main newspapers, as well as the word leak. The Fed actually has told me I should not talk about leaks, but I should talk about informal communication. But if you search on that, you don't get much. The Fed themselves use the word leak, so with apologies, I'm going to have to talk about leaks. I find over 100 FOMC documents talking about leaks. Typically, that means that the transcript for one meeting would have a discussion of leaks. So when I say 114 documents, you should more or less think about 114 meetings where they talk about this. And let me show you here. This is a histogram of how many there is per year. Keep in mind that in recent decades, there's 8 FOMC meetings per year. The average number of documents per year with leak discussions is almost 2. And if anything, things are not getting better over time, a slight upward trend. So the FOMC itself seems pretty concerned with this stuff. There's a really long table in the paper. I just did a screenshot of the first part, so you can get a sense of what they're talking about. The first line here, information security at the reserve banks. That shouldn't come as a surprise given the calendar evidence that we just went through. Lack of results of investigations of prior leaks. Then one of the interesting ones is there was a really long discussion about leaks in the January 2011 meeting. I'll come back to that. There's some discussion of leaks of Larry Meyer, macroeconomic advisors, and it just sort of goes on and on. And as further evidence that they care about this, steps have been taken to try to clamp down on it. So actually the FOMC statement itself emerged because of leaks. So there were a series of leaks to David Wassel at the Wall Street Journal from 89 to 93, after which Congress got upset about it and basically made the FOMC issue a statement when they made a decision so that everyone would know at the same time. Similarly, the press conferences that you may be following, I think are also at least partly related to leaks. So remember from before that we had in January 2011 a long discussion of leaks at the FOMC meeting. That was actually just before the first press conference, a couple of meetings before. And the discussion at the FOMC meeting led to an FOMC policy on external communication that basically says, as I highlight here in blue, that committee members should stop characterizing each other's views and instead refer to what the chair said at the press conference. Interestingly, also, you may remember that initially there was actually a pretty long gap between when the statement came out and when the press conference started. But then in March 2013, that gap was shortened, but basically the statement was delayed to have a shorter period in between the statement and the press conference. And Bloomberg interpreted this as basically Bernanke getting ahead of leaks from the Reserve Bank presidents, giving investors less opportunity to misperceive the Fed's intent, which was basically a way of saying that the presidents supposedly were spinning the statement in their preferred direction, kind of priming the market before the chair had a chance to say anything at the press conference. There's also some more standard approaches to cutting back on leaks, which is withholding information from other policymakers or limiting attendance. In terms of withholding information, I mentioned before that these reserve banks are submitting what's called discount rate requests to the board at least every 2 weeks. And then they each hear back whether their request was approved. And generally the requests are not. What will happen is that if a lot of people want interest rates to go up, then at the following meeting they'll increase interest rates. But each reserve bank gets to know whether their own request was approved or denied, but they don't get to know what the other reserve banks requested or whether those things were approved. So that might explain why these one-on-one calls and meetings between the governors and presidents are important, because that's essentially how the presidents can keep track of what's going on with all the other presidents and with the governors thinking during the FOMC cycle. All right, so let's start thinking about what are some good ingredients for a model of this informal communication game between policymakers. So let's start from political science. So there's a very nice paper by Posen that lays out all the different kinds of leaks that they talk about in political science. And so the policy leak is one where you leak in order to basically help to further one of your policies. Subtypes of that is the internecine or the infighting leak, where people try to strengthen their own position by leaking. And then also the counter leak or the record correction leak to neutralize disclosures by others. So in a survey of US government policymakers, there's a survey by Linsky, I think it's from the Kennedy School. He asked whether policymakers felt it appropriate to leak to the press, and almost half said yes. And interesting that the most commonly cited reasons for leaking were policy leaks. Okay, so you can see the percentages stated. I'm going to try to argue that these policy leaks, and especially these internecine leaks and counter leaks, are also important in the Fed context. So there's a really fascinating letter from Chairman Bernanke to the FOMC in August 2010, where essentially Bernanke is upset with some recent leaks to the press. And consistent with this being about infighting and internecine leaks, Bernanke says that it damages the reputation and credibility of the institution if the outside world perceives us as using leaks and other back channels to signal to markets, to disseminate points of views, or to advance particular agendas. Okay, so you can see that the agendas being about disagreement. He also says, it's my hope that participants and observers are not intentionally or tactically conveying confidential information. Again, you can see the disagreement and the tactical aspect to this. And so this is not just a recent thing. Here's a quote from Chairman Volcker that basically says, damn it, if somebody else is leaking, I'm going to talk to a reporter to get my story out. Okay, so this is just a few quotes. There's more in the paper to argue that leaks are at least partly driven by infighting between policymakers. Okay, so but why does it work? It works because it drives market expectations for policy, and the channel is that the Fed cares about market expectations. So I think probably the strongest evidence of this is that the Fed before each meeting, runs surveys of the primary dealers and of the market participants, so those are a bunch of large investors, and they ask them, what do you think we're going to do? And now there's even a private company, Macro Policy Perspectives, that surveys the same people that the Fed surveys in order to figure out what those guys said and trade on it before it has a chance to affect policy. But you can also, we can go through a few quotes from the transcripts that suggest that market expectations really matter for policy. So the best one I found was from Richard Fisher, the former president of the Dallas Fed. He says, I'm just saying that if we can, in every way possible, however we do it, we should try to preserve the options to be debated at this table, and then not use the argument that markets expect us to do X or Y. What's leading the markets to expect that? I haven't seen this broad-based discussion that we're having in the speeches. Okay, so that's effectively Fisher saying, you know, you guys are leaking to the press and then coming here and telling me we should do what you want. And he's obviously upset with that. The paper has several other quotes that says basically if somebody has told the market we're going to do something, that ties the hands of the committee. I put one here from Bernanke. Here's a couple of older ones from Greenspan and his vice chairman Corrigan from the 80s. All right, so importantly, what seems to be tying the Fed's hands is not just market expectations in general, but what someone has made the market believe. And so this is a conjecture, but I suspect what's going on here is that if you tell the market that you're going to do 25 basis points and then you don't, then you look like you're flip-flopping, and that's bad for the Fed's reputation. And so an important aspect of this is that if, therefore, disagreeing policymakers are trying to move the market in the preferred direction, they can't do it in public. Okay, so why do we get all this informal communication or leaks? It's because if you want to move the market, well, if you're doing it with confidentially stamped documents, you can't do it in public. And if you're doing it by characterizing or perhaps even mischaracterizing the views of other policymakers, well, then you also can't do it in public because the policy that I mentioned before states that you are not supposed to characterize other people's views in public. Okay, so this is actually a pretty standard issue in political science, that if you want to move the market through a policy leak, you have to provide some supporting information. Suppose it says that plants must be watered by leaks. And I put also a quote from Abel that says that when it suits an administration's purpose to leak secret information to the press, it simply ignores or temporarily overrides the document's classification. Okay, so that basically says that policymakers are in a tug of war over market expectations because market expectation ties the Fed's hands. And that tug of war happens partly, at least in private, because the policymakers are conveying confidential information. On the cost side, I've talked about the disclosures tying the Fed's hands, so reducing policy flexibility. The other two that come up a lot in reading the transcripts is damage to the central bank's reputation. You may have followed a few years ago, Jeff Lacker, who's one of the Reserve Bank presidents, actually had to resign from the Fed for his involvement in the leak, and there was lots of congressional hearings, and it didn't look pretty. I put a quote here from Greenspan, and let's skip that one. The third cost of leaks is that the deliberations between policymakers becomes worse. So Chairman Bernanke says that leaks threaten the free give and take of ideas. And basically Greenspan and Volcker, prior chairs, are saying exactly the same in these other quotes. So now we're ready to write out a very simple game theory of this policymaker interaction with the objective of figuring out when will leaks happen and who's going to be leaking and whether that's welfare increasing or welfare reducing. All right, so in practice, there's 12 policymakers voting, there's 19 participating. To simplify, I'm just going to have 2 in the model. D is going to be the dove and H is going to be the hawk. And they last decided on interest rates on date 0, at which point D had a preferred interest rate of R0D, and H had a preferred interest rate of R0H. Now, the next time they're going to decide an interest rate is going to be on date 2. And the model is about what happens in between date 0 and date 2 in terms of information disclosure. So we're going to keep track of how policymakers' preferred interest rates evolve over time as news comes in. That's those little E's. So from date 0 to date 1, there's some updating to policymakers' preferred interest rates. There's further updating up to date 2, and all these various shocks evolve random walk and they're uncorrelated. So the policy rate, as I said, is going to be set at date 2. And crucially, the policymakers observe from internal communication how their own preferences and their colleagues' preferences evolve over time. And the model is about whether they're going to decide to disclose the date 1 information to markets at date 1. If they disclose, then policymakers' hands are to some extent tied. The way I'm going to capture that is by putting a term in the loss function to capture a loss from the actual policy rate chosen at date 2, differing from what policymakers who disclose made the market think was the policymaker's average policy preference. So the loss functions are first a standard term that each party is upset if he or she doesn't get their way, and then this additional term that kicks in if somebody leaks and makes this dummy here be equal to 1 because a disclosure has been made. So then let's choose the day 2 interest rate to minimize that loss. And you can see, this is just squared objective function. So what's going to happen is that if nobody discloses anything about these internal preferences, then the chosen interest rate is just the average of what the policymakers want. If somebody discloses information about the date 1 preferences, well, then the market expectations based on that disclosure will have some weight, and the chosen rate will be a weighted average of what policymakers want and what they have made the market expect early on. Okay, so what's important here is this beta. So how much weight does the market expectation get? Okay, so then who's going to disclose what? I'm going to make one crucial assumption here, which is that you don't have to disclose all information as a policymaker. You just have to disclose what goes your way. So I'm going to first define what's the rational expectation given internally known information. Then I'm going to assume that a policymaker making disclosure can make the market expect any value for the average policy preference within S star of the truth. So that's what's going on here. And then if both policymakers are disclosing and spinning the news, then the spin is going to add up and potentially cancel. So now you can see this is a very standard prisoner's dilemma. A strategy for a given policymaker is a decision whether to disclose, and if yes, what value of spin to use. And Nash equilibrium is just an optimal strategy given what the other policymaker is doing and market expectations. And what happens then is the prisoner's dilemma outcome under certain conditions. So the conditions for when you get a prisoner's dilemma where both parties disclose is that you need that there's sufficient disagreement and sufficient spin. Okay, so I'm going to measure disagreement by the distance between the policymakers' preferred interest rates. And when I say we need sufficient disagreement to get to this equilibrium, it just means that the amount of disagreement is large relative to the sigma v captures how much preferences might update between date 1 and 2. Okay, so this left-hand side inequality says there's a lot of disagreement relative to potential news. And then the other inequality says that the potential amount of spin has to be sufficiently large relative to the amount of disagreement. In that case, D prefers disclosure regardless of what H does, same with H. And the unique Nash equilibrium is that both disclose and spin as much as possible in their preferred direction. Okay, so let's try to graph this out. So remember, D is the dove and H is the hawk. And so if D is the only one spinning, D would want to spin negative. and one can work out that D would want to spin negative by half of the disagreement. Conversely, for H is the hog, H would, if he or she was the only one spinning, spin positive. Now, if the other person is spinning, then you're just trying to counter spin. And so this is best seen in a graph here. So this sums up the model. Okay, so D's spin is on the y-axis and H is on the x-axis. So remember, D is the dove and would spin negative if D is the only person spinning. Then if H starts spinning positive, then D is going to have to spin negative even more to get to the same total overall spin. And so that gives you that negative slope. Similarly, H is a hog and would on its own spin positive. Then if D spins negative, H spins even more positive. And so we end up down here with both spinning as much as possible and the spin canceling each other out. So that's welfare reducing, because now all we've gotten out of this is that flexibility is lost. So for those of you guys who do theory, it's possible to write potentially some fun models of this this game where leaks may not simply cancel out. I listed here 3 possibilities for how you could get leaking actually working in equilibrium, as opposed to ending up in the standard prisoner's dilemma where both disclose and it's strictly bad for everybody. All right, so what can we do? So of course, we could avoid disagreement and we could just appoint a bunch of people who all went to MIT and Harvard and thought the same way. That's probably not a good idea, because we want to have a bunch of people with different thinking involved in policymaking. Alternatively, maybe we should just have policymakers disclose their preferences in real time so there's less to leak. That's probably also not a good idea, because then the Fed's hands would be really tied and it would really lose flexibility. So what I'm going to suggest is that we're going to think about this beta. Remember, that was the weight on the second term in the loss function of how bad it is for policymaking if we're seen as flip-flopping. We need that beta to be smaller. And the way to get the beta to be smaller is a better understanding of the Fed's policy framework. So for example, you and I probably don't think that the Fed is flip-flopping if they change their mind because there was some new data on initial jobless claims or a non-farm payroll that came out that made it rational to change. But that may not be the same for the public at large. There's a Brookings survey that says that only 34% of even Fed watchers and academics say that they have a clear understanding of the Fed's reaction function. And so we need the beta to be lower. That means we need the policy framework to be better understood. How are we going to make that happen? Well, maybe we should not have FOMC rotation. Okay, so currently of the 12 reserve bank presidents, there's 4 voting, plus the New York Fed president always votes. And it's a different set of 4 each year. So what that does is that there's a lot of people involved and it's not even the same ones all the time. That makes it particularly hard to understand the Fed's policy framework. So maybe we should appoint a number X, I'm not going to take a stand on the exact number of X of the reserve banks, and say, look, you guys are the super reserve banks, you always vote, and there's no rotation. If this helps the public's understanding of the policy framework, then beta would hopefully fall and things would get better. I want to finish with the Lagarde article that I mentioned before. Remember, it was the article titled "No Phones, No Leaks." In addition to no phones, she actually had all the ECB people go to a retreat at some castle in Europe to try to essentially change the culture. She's going to, apparently, unlike Draghi, try to listen more and not front run the decisions and sort of ignore what everyone else is saying. In return, she asked that they keep internal disputes internal and out of the media. So, we'll see how she does that. Being an economist, it's a little hard to have an opinion about these culture issues, but maybe we should get some colleagues from organizational behavior involved in thinking about these issues. Thanks a lot.